So if we now start thinking about that, and so we still start in the M&A and thinking about what is actually happening in an M&A process in general, what are sort of the steps in a way that we need to go through? And of course, these steps are multiple. And I will probably leave a couple of them out in a brief summary like this, but sort of it's important to get some kind of overall framework still for what we're talking about. So from my point of view here, the first thing when we are getting involved in an M&A process, that is to start thinking sort of about why should we be making an acquisition in the first place? And what is the answer to that question, really? Well, to a very large extent, that is about sort of finding the strategic mapping. Sort of how would a particular target fit in to my own company, my own organization, my own ambitions, what it is that I want to do. And that is sort of key because, of course, if we were go wrong in that perspective, well, there we will have troubles as a starting point. The next step then is, of course, which of all possible targets should we be approaching? And of course, these two things, they interact, right? But you kind of want to separate them out. Sort of why are we going to do that? And which specific company are we actually going to acquire in that step? And that, of course, also builds up, hopefully, over a slightly longer period of time. We get to know the potential target over time. And thereby sort of that will help the process in acquiring another company. But there can also be an opportunity that we just need to seize, sort of. So there are many different ways in this search and selecting the potential target that we do have. The next step then is to really think, what is it actually that we're going to buy? So we need to find out, are there sort of any bad things around this company? Sort of what are the pros and the cons? Can I trust the organization? Can I trust the numbers, etc.? So we kind of go into that due diligence process, which of course is a legal kind of approach to it, but it's also very much about really, really understanding sort of what is the business all about. So trying to make sure that we are in a way not fooled by our own expectations, or sort of course, by any kind of foul play that might be out there in the targets in its own right. And then we have another kind of setup here that we need to elaborate on. And that is, of course, how much are we going to buy? How much are we going to pay when we buy that particular target? We need to start thinking about the valuation process. How are we going to come up with a number that we are willing to give up in order to get something? And of course, how are we going to finance that? Is it going to be an equity transaction? Are we going to let the former owners into our company? Or are we going to issue equity somewhere else that will sort of help financing and them paying the old owners of the firm? Are we going to borrow? How are we going to do that? Short term, long term, what kind of sort of deals we will set up from that point of view? So the how much and how financing is, of course, a very critical step. Then, sort of, we go into negotiations setting. When we have made up our minds, how much are we willing to pay, we will go into the negotiation with the potential sellers. And that is a game in its own right. So it's a little bit about when is the sort of transaction actually going to take place, and sort of what will the outcome be from that transaction. And then we've been through all of that. And then we are getting so tired. That means that we close the deal in a way and everything is said and done. Well, honestly speaking, that is the point in time when the work begins. So what does that mean? Well, it means integration. How are we going to put these two companies together? And it might actually be that, of course, we have bought companies before as well. So the integration process with several cultures, etc., comes into play here and becomes even more complicated. But it also means things like, what will the financial reporting look like? If we are going to evaluate the outcome of the transaction, well, we need to be able to understand and read the reports in a meaningful manner. Is this a value-creating acquisition? Does it turn out to be what we wanted it to be, and thereby be creating value? Should we be kind of adjusting numbers? And why should we? Why should we not be adjusting numbers? There are so many questions surrounding that. And then on top of that, we do have market effects. If we are a listed company, which sort of then has a share price, and how will the market react to announcement and to the progression thereafter? So all of those consequences is also something that we kind of need to be aware of. And if we just sort of look at this sort of stylized picture of the M&A process, well, it's not hard to sort of realize that there are so many places where this can actually go wrong. And given that, it's not that surprising either that so many acquisitions fail, at least from a financial point of view, which is the absolute majority if you just look at the numbers. But so many people involved and so many steps along the way where things can actually be complicated and cause problems. I think it's important to be aware of that, because if we now sort of just take out parts of this map and sort of start thinking about what is happening there, well, it's easy to sort of focus that is where things can go wrong. No, there are all of these other places. And it actually starts with the fact, am I doing this for the right reason? So why are we doing acquisitions then? Well, I would say we do have a couple of different kind of motives in this. The first and sort of the primary one, it has to be we want to create additional value and thereby also create additional shareholder value. We want to buy another company because we do believe that we can do something good about it that creates additional value. That can also, of course, be protecting value, but that's also a way of creating value. The secondary layer of that is, of course, that it fits in to the corporate strategy for growth and profitability in general, because the growth and profitability is what drives the primary motive, i.e. creating shareholder value. So we need to kind of understand how these things do play out and sort of fit together. But then we might, of course, also have a whole set of other motives, which we not necessarily want to talk about or explicitly talk about, but that we as individuals might actually talk about. And sort of, what are those? Well, these are just some that sort of research has told us about. And if we look at this list here, many of those motives that you find here, they tend to be related to very fundamental feelings that we as individuals might have. And one of them is fear, for example, right? Don't buy me, I better buy you, kind of thing, right? Or everyone else is doing it, so the fear of being let out in this, well, that's also some kind of fear, right? And that, of course, relates to the fact that my competitor steals something from me that maybe I should have bought, okay? Last chance of buying something, scary kind of thing, right? It's sort of who. And then we have this very individual one, trading an empire. I'm the CEO, I want to be strong. I want to show it's better to be the head of a big thing, big company, than a small one. So the empire building is, of course, important. And that also relates to show the ability to act, etc. And then we have these external parties, media, right? There's so much matchmaking out there in media in general. And that also goes to financial intermediaries who sort of say, hey, have you seen this target? Shouldn't you Well, maybe you should, maybe you shouldn't, right? So that's another dimension into this, which of course we need to be aware of and sort of say, are we really making the decision to acquire another company for the right reasons? So all of these things are kind of there lurking in the background, and we need to sort of be aware of them. They might be driving our decision to make the acquisition, even though maybe we shouldn't have done it. So let's sort of keep that kind of structure at the back of our head when we sort of proceed to the more fundamental parts of things. And sort of the one of those things, that is valuation. We need to be elaborating on how and what are the consequences of valuing a target company in a certain way. So what kind of techniques do we have? How should we be performing evaluation? Well, let's take one step back and sort of align with the key of all value calculations, which is discounting future cash flows. If we are going to make an investment in whatever it is, okay? Everything from machine to investing in new people to buying another company. It all boils down to discounting future cash flows. So we need to identify cash flows, and sort of in a very simple example, let's say that we have cash flows for 3 years and we do have a project for 3 years. In this case, 545, 340, and in total, they're 1,040 in year 3. We have an opportunity to buy that for 1,500. And let's say that I require a return of 10% in this process. Well, how am I going to handle that? Well, I'm going to discount those cash flows by 10%. I am going to move these cash flows in time by 10%. And I do that by dividing per year those cash flows by 1 plus that requirement, i.e. the 10%. So I will take 545 divided by 1.1. I will take 340 divided by 1.1 squared, etc. And if I do that, under those conditions, in this very simple case, I do obtain a figure of 1,558. If I am then sort of required to pay 1,500 for that, well, then I do have value creation. I do have a positive net present value of 58. That is basically to say I will get a little extra. So what does that mean then? If we're just going to think about what that means, well, it means that I need to give up a little less than what I get. And I've taken risk, time value, money, etc., into consideration. I still get a little extra. And that little extra, that is value creation, really. But let us elaborate on that from a slightly different perspective. And that sort of slightly different perspective, that is to think about, well, what kind of a return does that really represent then? Well, we can do that by sort of applying our internal rate of return. We're trying to find sort of what number that we should discount with in order to get exactly 0 in value creation. And that in this case takes us to 11.9%. Well, okay, so if I pay 1,500 and obtain 1,558, that means they obtain a return here of 11.9% on a basis. Okay, I require 10, so 11.9 is actually good. Okay, I obtain 11.9% if I pay a in this case that is lower than my requirement of 10%, either 1558 in relation to 1500. We need to keep that one in mind. If I were to come up sort of with a figure with 0 MPV, well, in that case, that would have meant that my expected return, the internal rate of return, that would have been exactly my discount rate, the 10%. Let us remember that. This is sort of the general approach when it comes to value anything. So the question then, what do we do when we should value a firm? Well, we do have the most important model that we actually can come up with, and that is sort of the free cash flow model. We discount free cash flows today with an appropriate discount rate, which is the weighted average cost of capital. We do that from now until we do believe that the company will shut down, which by assumption sort of is going to be never. It will continue going on forever. So we have two-period model. We sort of have a first part, a set of years, during which we sort of are making assumptions that are completely free, the first 2 years in this. And then we're trying to say, well, we have some kind of long-term cash flow generation ability in the long run, which will grow with a certain growth rate. That is calculating the horizon value or the terminal value. And we do that by taking the well-known sort of Gordon growth formula in this, which you have there out to the right. So the question we need to ask ourselves is the following. What is really a free cash flow? Well, the free cash flow, it's nothing less but an operating cash flow after tax. So what you do have up there, well, that is operating cash flow after tax. What does that mean in turn? Well, it means that we need to have a good understanding about what is the operations of our firm. And what do we mean by operations? Well, we mean what are we actually doing in terms of selling goods and services to our customers one way or the other. And exactly what those goods and services are, well, that is about understanding the business in its own right. And then we will sort of match that with this weighted average cost of capital, the requirement, the risk-adjusted requirement that we do have. There are many ways here, of course, of going wrong in this calculation. But sort of this is the structure, and this is sort of how we need to be thinking about things. Note, for example, just to shed some light on something here, right? You see it says E0 up in the formula. What that one says is actually its expectations at the time 0. What is an expectation? Well, an expectation is not one cash flow. It's a structure of lots of cash flows that potentially could arise in a particular period. And it's like an expected value of that. So we can go wrong by, for example, just saying, I'm going to take that value because I believe the most in that one. That is not what we're going to do. That is not an appropriate way of doing our calculations in a free cash flow model. Okay? But the key is we are valuing the left-hand side of the balance sheet. And that is sort of what we're going to do. So we need to have a good understanding about this, i.e., we are valuing this side of the balance sheet, which is what we call invested capital. Okay, so we do that by discounting our free cash flows, and then we are going to separate that one out between what we do have here as some kind of net debt and equity. So in order to come up what we should be paying for the company or the shares of the company, we need to deduct the value of the net debt in order to get there. That is sort of what we should be doing. Okay? So the approach is there. We need to have a good understanding about how the valuation model works. That is something that is actually quite hard when it comes down to it, and particularly when it comes to calibrating the weighted average cost of capitals, etc. Okay. But then we have other techniques which people use in practice, and people use like multiples, right? This is what we should be doing. We should be trying to identify future cash flows and sort of what is being generated, but in practice, sort of lots of people do multiples. And what kind of multiples do we apply? Well, this is sort of a set of those kind of things, right? Price earnings, price book, enterprise value to sales, enterprise value to EBIT, to EBITDA, to EBITDA. We're trying to take away a lot of things to get to something. Enterprise value to employees for consultancy firms, for example. And I have sort of provocatively a little bit here in this presentation, I plugged in something else, which is price to whatever, which means that we see a lot of these kind of connections in practice that you start to think, what is the logic behind this? Okay. But what multiples do for us in terms of valuation in general, well, that is say we try to take one piece of information. If that might be EBIT, EBITDA, EBITDA, net profit, book value of equity, something like that. And then we sort of look at other transactions or sort of what other companies are valued at. And we say, with this multiple, our target company is going to be valued with the same number. Well, I thought that the whole sort of plan about this is that two companies shouldn't be exactly alike, which means that the way one company is valued should not necessarily be the same that another company is valued. So why should I pay the same value for a company that something else is valued at when they are not the same? That is actually worth thinking about. And it takes us back to something that is company specific, which is actually going back to this. We need to estimate the cash flows and the inputs for the individual company that we're looking at. Okay, let's try now to sort of take and align the discussion that we had regarding sort of general NPV kind of approach, the net present value, all firm value models. And that is sort of what is the expected return on a market-based valuation. What do I mean by that? Well, if I now have sort of calculated a value according to the models, how big a return would I expect to obtain on an annual basis on that company? Let's then remind ourselves of what we said before. That is to say, if I invest in something where I pay exactly the price that is motivated by the discounted future cash flows, well, under those conditions, I will get exactly the return that I require, i.e. the number I use in order to discount those cash flows with. So the answer to that question is on invested capital, on the left-hand side of the balance sheet, on the operations, the expected return is the WACC. And let's 8, 9, 10, maximum 11, 12% in total. Maximum. Normally we're talking more 8, 9. If we are talking about that on the share price, that expected return is the cost of equity, which is a little bit higher because the risk in equity is higher than the risk in the operations. But still, we are probably talking about somewhere between 10, 12, 13%. If I do pay the market price or the price that I've calculated, the fundamental value from my sort of assessments of the future cash flows. Then comes a very critical question here, and that is, how many companies have WACC as the target operating return? Sort of how many companies out there are happy with saying, I have a weighted average cost of capital of 8%, so my target for my future return, that is 8%. This is what I'm going to achieve. Very, very few, right? Normally, we tend to have return requirements of 15, 20, even 25%, something like that, and in time. Well, if we buy something, if we're making M&A transactions at sort of a market price or at fundamental value, well, in that case, there is no chance that we can obtain those ambitious returns of 15, 20, 25% if we sort of would pay a fair price. Unless we haven't included some of those future cash flows in our calculations of the fundamental values. And what are those? Well, it tends to be this absolutely beautiful word of synergies. i.e., this little magic kind of thing. That's sort of when we take one company and we take another one and we're going to put them together, and sort of the net cash flows is going to be bigger than the ones from the individual company, which of course can be achieved in many ways. One, we can cut costs, we cut cash outflows, generally speaking, laying off people, shutting down head offices, being better at supply, whatever it is, right? Many ways of sort of cutting what we need to pay for the services and goods that we acquire one way or the other. Or we actually manage to sell more because we are bigger, or we have sort of a broader set of products and services that we do offer our customers. So we can sell even more. So we are talking about revenue synergies, and we are talking about cost synergies. So not paying for those synergies to the seller, that is sort of the key. But when we meet companies, we meet people from companies, and we look at the values that acquirers are willing to pay, well, it seems like we are paying for synergies as well to the seller. And just note, the seller simply cannot realize those synergies. They cannot put the two companies together. They are stuck with the standalone company. So that means that we, as a buyer, give up a lot of things to the seller for getting the pleasure of realizing them with uncertainty in the future. That is as close to masochistic behavior that we can have, I think, right? And that is a little bit scary. And when does that happen? Well, it tends to happen most importantly when we have many bidders for the same company. Then it normally becomes worse. And of course, we tend to think a little bit too optimistically about those synergies. So, what should we be doing and what should we not be doing? Well, we should pay less than sort of the fundamental value, including synergies. As a standalone, no, we can pay the fundamental value of the standalone company, but as soon as we start sort of paying more than that, it actually becomes problematic. We give up our value creation to the seller. That, of course, means that there are two other must-dos that we do have. And that is, we need to separate out between the standalone company and the integrated company. And that is related to the synergies, right? We should to the best of our ability, try to pay for the standalone company, which is the value that the seller can generate. Otherwise, we give up our value. The integrated company, the value that we obtain, well, that one, of course, includes synergies. And that means we need to generate synergies, right? That is, of course, extremely important. We need to make sure that the synergies from this matching, remember we talked about the strategic mapping initially, that is super important, right? And there is another thing here. We need to know when to leave the negotiation table. So when has the price become too high? When am I not going to go through with this, okay? And the flip side of this is, of course, what should we not be doing? Well, we should not be paying for synergies. And that is very interesting because many companies even write the goodwill that I show on the balance sheet, well, that is synergies. Then I personally get pretty shocked. Sort of, hey, you have paid for something that you are going to do, and you even admit it. Now we're sort of a little bit complicated here, right? Don't go into a bidding war, of course, because you will pay more than you expect or want to. Don't get emotional about it. Because, of course, when you start getting emotional about the acquisition in its own right, there is always a risk that we do too much. One of those hidden motives, of course, we were talking about, right? And, of course, a bad deal cannot really be rationalized afterwards, and particularly not forever. For a certain period of time, okay, we can say, yeah, it will come, etc. But in the long run, sort of reality will catch up with you. So that means, of course, know exactly, at least to the best of the information we do have at the acquisition point in time, sort of when do I leave, when do I enter this transaction, and what do I get out of it at the best as I can. This is sort of very easy to say from a theoretical kind of me approach here, and it's much harder to do in practice. Sort of, but if we have done our job, if we've done our analysis, if we made the matchmaking in the best possible way, of course, it becomes a little bit easier. So I want to shed here at the end also a little bit on perspectives on value creation and sort of what is value creation in another step. And that is sort of when we think about it a little bit afterwards. We looked at this MPV kind of approach, which is a way of determining, do I expect value creation from this transaction? So let us elaborate a little bit on what is value creation in general. Well, value creation happens when you generate a higher return than you would kind of get somewhere else on that money, okay? That is to say, you invest a certain amount of money, and of course, you could have taken that money, you could have put it somewhere else on a competitive market, and that return that you would have obtained there, that one is like a threshold. If you get a return from this investment that exceeds that requirement, well, in that case, you will be creating value. So if we go back to our case that we have with the MPV, in the sense that we require 10%. By saying that I require something, that means that I can get that return somewhere else. So that means that I give up that return of 10%. And if my investment here generates 12 during a year, and I invest 1 million, then I do actually create 20 like that. On the other hand, if it only generates 8, well, then it actually destroys. So this is sort of a very simple way of thinking about value creation. But there are, of course, a couple of hidden kind of dimensions into that. And one is, of course, to think about what is it that we're investing in? So what is the investment? And this takes a little bit back to, if we're making an M&A transaction, who is sort of making the M&A transaction? How should we be evaluating value creation at, shall we put it, different levels in the organization or individuals and organizations that are affected by that? Well, I would say that we can put 3 layers on this. One is to look at the acquired firm. What is value creation from that firm's perspective? What is the value creation from the group's perspective? And what is the value creation from the market perspective? Well, value creation for the acquired firm. Well, what kind of investments do they make? Well, it's nothing about buying that company. What they do is that they buy inputs to production and services process, and they are going to do that as cheap as possible. Then they're going to have a lot of value-added processes within the firm. Okay? Either they're going to be super good at what they do and they have some kind of niche that they're operating in, so they can price whatever product and services they do have to the customers. And whatever they have invested in, whatever they have bought, that is, i.e. machinery, etc., that is what they are going to generate a return on, and that is what the value creation looks like in that process in the acquired firm. I.e. the investment is in production capacity in this. If we do take one step up, okay, and we think about the group, what is value creation from the group perspective? And we can state it differently. What is the value creation from the parent company perspective? Well, the parent company, the group, has acquired the subsidiary. So the investment from their perspective, that is sort of the money they paid to the previous shareholders of the acquired firm. So the group needs to generate a good return on the money they spent when they bought that company. That means, for example, that they need to generate a return on goodwill, on revalued assets as a part of that, and all of sort of what represents the acquisition cost of buying that other company. That also means the depreciation and amortizations of the acquired assets that we have is actually quite reasonable, because it's a way of consuming and using those resources and assets that you actually bought, just like you would buy a machine and use it on the lower acquired firm level. It's just here that the investment is much bigger on the group level. So, next step, that is the market level. What is the investment on the market for shareholder? Well, that is what we paid for the share of that company. And that is based on the expectations, i.e. the valuation of the firm. So there we are thinking about the expectations of the future, and they might be right, they might be wrong. In many models, we do sort of expect that sort of there is some kind of efficient market, i.e. we have incorporated all of the information and it's reasonably priced. Okay. But in practice, of course, market can be right, market can be over-optimistic, under-optimistic when it comes to pricing. But we need to pay that price of buying the share. In expectation, it's a zero NPV investment. So there is a question here. There are 3 different layers of value creation. How much are we going to boil that one down? Through organization down to the acquired firm, what is sort of represented by the market, etc. Well, the setup is slightly different, right? We need to really think through those kind of things. So, stated differently, all of these sort of problems and issues that we do have, and I've sort of just tried to mention a few here when it comes to value creation, when it comes to valuation and the entire setup. Sort of what is being done at Executive Education here at Stockholm School of Economics, that we have actually set up a program when it comes to M&A that follows this logic, where we cover these different kinds of steps in the M&A process. Of course, talking about valuation, talking about implementation, talking about integration, lots of the things that I haven't covered here, but I sort of put emphasis on the value creation part in general and the valuation concepts as such. But in order to be successful, we need to do all of this. So all of these dimensions are critical. That said, sort of, we are approaching the absolute final minutes of this. So if there are any kind of thoughts, any kind of reflections or anything like that that you might have, well, I will try to sort of cover those as well. I do not see anything for the time being. But I am more than willing to take any kind of questions that you might have. There was a question, I think, right? Philip, was that so? Do you have a question for us? Well, sort of failing in general, yes, exactly. I mean, we have a lot of failing is normally when we're talking sort of about in general, sort of whether we are making the return or not on it, that we're sort of expected to be, yeah, in general. So that is exactly what it's all about. And it seems exactly like research sort of indicates exactly those kind of levels of failure from a financial point of view. Anything else? Let's see. How do you propose to identify the strategic mapping of a potential buyer? So to identify a company that might want to sort of buy yours. Well, of course, it's very much about the industry. It's sort of very much about sort of finding what kind of technology, for example, that you have in your company that sort of would benefit someone else. And of course, vice versa, if you are the acquirer, what kind of technology, what kind of cultural fitting, etc., do you have? Because when we're talking about strategic mapping, right, we're talking about something that is actually quite broad. We are talking about sort of not only fitting on the same markets or complementary to that market, but we're talking about technology. We're talking about that market aspect. We're talking about the cultural aspects of the two companies as well, because that's extremely important when it comes to strategy. So it's a very multifaceted area. But doing your job and really, really sort of looking into either the target or potential acquirers that you do want to approach if you're going to sell, I think that is the key. If you really care sort of about the company that's going to proceed, it needs to be put in a nice care, i.e. a company that you sort of really appreciate from that point of view. So that is sort of very much what that one is all about. How should we think about synergies and what is sort of your view in them? Well, synergies are super hard. That's the first thing. Cost synergies, we do have some kind of power over. I mean, we can lay off people, we can shut down an office or so we do power over them. When it comes to revenue synergies, i.e. selling more to the same customers and that kind of things, they tend to be really, really problematic to realize. You know, we cannot control our customers. So be careful in estimating your synergies. Don't overestimate them. I think that is sort of the most important part in this, because they tend to be very much harder to realize than we do think as the starting point. So yes, be aware of them, try to make sure, identify them, and try to make the best out of those. I think that is the important part. Let's see, what do you say are overall do's and don'ts in integration according to research? Well, I would say, as a starting point, if we look at the companies that are really, really successful, I would argue they do what is absolutely necessary to do as a starting point. What do I mean by that? Well, for example, integrating systems for financial reporting and similar things, because we need to have those things aligned. But don't rush. And what do I mean by that? Okay, don't try to just impose your own way of doing things immediately. Let sort of people settle in. Let's try to benefit from the good things of the acquired firm in sort of a step-by-step kind of approach. Because the trap here, that is to scare people, to make them not feel comfortable in the acquired organization. And then you start to have problems with good people leaving the company, with people even sort of counter sort of work what you want them to do, right? Doing the wrong things, protests in a way. That is, of course, extremely complicated. So that is sort of a major don't. Be very, very careful. That also means that you need to plan the acquisition and the integration process lots ahead, really. I think, as I said initially, we tend to be tired when we've signed the deal. That's when the process starts. So start the integration process much earlier and years afterwards. Work with patience. That's my do when it comes to that. Good. So seems like we have handled a couple of questions as well. So thank you for taking your time and listening in. And it's been a pleasure to talk to you, and looking forward to hopefully meet you again in the future. So thank you very much for today.